January 1st, 2026, a rule went into effect that mathematically prohibits banks from touching Bitcoin. Not discourages, not limits. Prohibits. This is the 1,250% risk weight rule, Basel III SC 060. For every $100 million in Bitcoin exposure, a bank needs to reserve $100 million in Tier 1 capital. The same capital that backs mortgages requires 22%, corporate loans, 40%, gold, 0%, Bitcoin, effectively 100%. And here's what nobody's telling you. This isn't killing Bitcoin. It's draining the liquid supply from the traditional financial system, locking it into cold storage vaults where banks can never touch it, creating what economists call a liquidity trap, but not for Bitcoin, for the banks themselves. While you were worried about ETF outflows and price volatility, over 1 million Bitcoin disappeared into custody structures. Structures that Basel III made impossible to lend against, impossible to use as collateral, and impossible to intermediate. This is documented. This is regulatory fact. By the end of this video, you'll understand how a single capital rule is creating the largest supply shock in Bitcoin's history. If this is already making your head spin, if you're realizing the game is fundamentally different than what CNBC tells you, hit that like button right now. Because what I'm about to show you next is how this creates an actual liquidity trap. Drop a comment and tell me, did you know about the 1,250% rule before watching this video? Be honest, most people who own Bitcoin don't even know this exists. That's why institutions are moving in silence. Subscribe if you're not already, because the next section explains why banks are economically prohibited from doing anything with Bitcoin. This is the mechanism. Now let me explain why this creates what economists call a liquidity trap, not for Bitcoin holders, for the banks themselves. Traditional bank business models with assets, market making, buy and sell to provide liquidity, profit from spread. Lending, use asset as collateral, earn interest. Repo markets, short-term secured borrowing targets lending. Custody with rehypothecation, hold client assets, lend them out. Under Basel III's 1,250% rule, every single one of these becomes economically unviable for Bitcoin. Let's take lending as a practical example. Analysis from European banking sources shows that a 1 million euro loan collateralized by Bitcoin requires 1 million euros in Tier 1 capital. Compare that to 1 million euro loan backed by gold, approximately 0 euros in capital required. 1 million euro residential mortgage, approximately 220,000 euros in capital. 1 million euro corporate loan, approximately 400,000 euros in capital. The bank can't price Bitcoin-backed lending competitively. To earn a 5% return on that 1 million euros in capital, they'd need to charge the borrower 5% just to break even on capital costs. This is before factoring in actual risk, operational costs, or profit margin. It's economically impossible. Industry confirms this explicitly. In August 2025, the Global Financial Markets Association wrote to the Basel Committee. Direct quote from their official letter: "The crypto asset standards restrictive capital requirements effectively make it uneconomical for banks to meaningfully participate in the crypto asset market and are constraining the ability of banks to intermediate and provide liquidity. Not challenging, not difficult, uneconomical, mathematically impossible. Market making, same problem. If a bank wants to run a Bitcoin trading desk with $500 million inventory to provide liquidity, they need $500 million in Tier 1 capital sitting idle. No bank allocates capital that inefficiently. The result? Banks are withdrawing from Bitcoin intermediation entirely. They're not selling Bitcoin they hold. They're simply refusing to provide the basic plumbing that makes markets liquid. No lending against BTC collateral, except at prohibitive rates. No market making in size. No repo markets for institutions. No rehypothecation for yield. This is the liquidity trap. Bitcoin becomes untouchable for regulated banks. And when banks can't intermediate, where does the Bitcoin go? If you're starting to see why this is actually bullish for Bitcoin's scarcity in the long run, even though it sounds bearish in the short term, smash that like button. This is the part most analysts completely miss. Comment below. Have you ever tried to borrow against Bitcoin at a traditional bank? Or has your bank told you they can't offer crypto services? Now you know why. It's not preference, it's regulation. Stay with me, because the next section reveals where all this Bitcoin is actually going. And it's not exchanges, it's permanent lockup. Now here's where it gets fascinating. The 1,250% rule isn't forcing banks to sell Bitcoin they already hold. Most banks never held significant Bitcoin on balance sheet to begin with. What it's doing is forcing Bitcoin into structures where it can never flow back into tradable markets. It's creating permanent supply drain through 3 mechanisms. Mechanism 1, ETF custody lockup. As of February 13th, 2026, US spot Bitcoin ETFs hold approximately 1,050,000 Bitcoin in segregated custody. Let me break down the largest holders. BlackRock IBIT, 765,294 BTC, or $50,890,000,000. That is 3.8% of total Bitcoin supply. Fidelity FBTC, 471,000 BTC, or $31,320,000,000 in self-custodied vaults. Grayscale, GBTC, approximately 260,000 BTC. That's over 1 million Bitcoin locked in custody structures. Now, here's the critical part most people miss. Under Basel III, banks cannot economically lend against these ETF holdings. Even though BlackRock's IBIT represents $50 billion in Bitcoin, a bank trying to offer a loan using IBIT shares as collateral faces the same 1,250% capital hit. Result? These ETFs become one-way doors. Bitcoin flows in through investor purchases, but it cannot flow back out into banking liquidity systems. It sits in Coinbase Prime custody. Coinbase Prime holds 884,675 BTC for multiple ETFs as of February 2026, completely isolated from traditional financial plumbing. Quote from Institutional Analysis, "Supply is no longer just scarce, it is unavailable. The Bitcoin exists. It's just locked outside the reach of bank intermediated lending, repo markets, and leverage. Mechanism 2, corporate treasury accumulation. Strategy holds 714,644 BTC as of their latest disclosure on February 9th, 2026. Marathon Digital, Metaplanet, and other Bitcoin treasury companies hold another 100,000 plus BTC combined. These aren't trading these holdings. They're accumulating and holding in corporate cold storage or non-bank custodians. Why? Because taking them to a regulated bank for custody or leverage triggers Basel III capital requirements that make the economics prohibitive. Basel III inadvertently created an incentive for self-custody and non-bank custody. If you can't get economic value from bringing Bitcoin into the banking system, why bother? Just hold it yourself. Mechanism 3, the custody services shift. Here's the twist. While banks can't economically hold Bitcoin on balance sheet, they can offer custody services as an off-balance sheet fee-based business. Coinbase Prime Custody, $245 billion in institutional assets as of June 2025. Custody is different from ownership. The bank isn't holding the Bitcoin on their balance sheet, subject to the 1,250% rule. They're holding it in segregated accounts for clients and charging custody fees. But those custodied assets? They're not available for lending or liquidity provision because the moment a bank tries to use them, Basel III kicks in. Net effect, Bitcoin accumulates in custody vaults, but the tradable float available for normal market operations shrinks. The data confirms the drain. Total Bitcoin on centralized exchanges is down from approximately 3 million BTC in 2020 to approximately 2,300,000 BTC in February 2026. Bitcoin in ETF custody, 1,050,000 BTC, which is 5% of total supply. Bitcoin in corporate treasuries, approximately 650,000 BTC. Bitcoin Last moved on chain in 1+ years, or the illiquid supply is approximately 70% of circulating supply. Basel III didn't create all of this, but it accelerated it. By making bank intermediation economically impossible, it pushed Bitcoin into permanent storage structures. Before we go further, I need to know where you stand. Comment below and answer honestly. Do you hold Bitcoin in self-custody through an ETF or on an exchange, or are you still on the sidelines? This matters because what I'm about to show you next reveals what happens when the liquid supply finally runs out. And it's not theoretical. We have historical precedent. Hit that like button if this is clicking for you, and subscribe because the next section breaks down what happens in stage 3 and stage 4 of this supply drain, the compression and the explosion. Now let me show you this exact pattern is already played out, not with Bitcoin, with gold. And it proves the Basel framework creates these supply drains intentionally. The NSFR 85% rule for physical gold, Basel III includes another rule called the Net Stable Funding Ratio, NSFR. For precious metals, it requires banks to hold 85% required stable funding, RSF, against unallocated paper gold positions. What does that mean? If a bank holds $1 billion in paper gold, they need $850 million in stable funding. This makes paper gold expensive to hold. Physical allocated gold, meanwhile, counts as a Tier 1 high-quality liquid asset with 0% risk weight. The result? A massive shift from paper to physical gold in 2024 and 2025. February 9th, 2026 was cited as an enforcement deadline for the NSFR 85% rule for metals. Bullion banks dramatically reduced unallocated gold positions. Demand for physical allocated gold surged. Gold vaults globally reported record inflows. The mechanism is identical to Bitcoin. Regulatory capital requirements make one form expensive. Institutions shift to another form with better treatment. The liquid, tradable supply shrinks as assets move into long-term storage. Scarcity increases, and price eventually responds. For Bitcoin, the twist is that there is no good category under Basel III. Bitcoin is always Group 2B, with 1,250% risk weight. There's no regulatory arbitrage to physical versus paper. It is all punitive, so what do institutions do? They exit bank intermediation entirely. ETFs, self-custody, non-bank custodians. The Bitcoin leaves the traditional financial system completely. Why this matters? Gold's supply drain under NSFR happened gradually over 2024 and 2025. Bitcoin's supply drain under the 1,250% rule is happening faster because 1. Bitcoin is digital and easier to move to self-custody. 2. Bitcoin has no favorable regulatory category. Gold at least had the 0% physical option. 3. Bitcoin institutional adoption is newer. The infrastructure is being built specifically to avoid bank balance sheets from day one. The supply shock is baked in. It is not if, it is when it becomes undeniable in price action. If you're connecting the dots, if you're seeing that Basel III isn't killing Bitcoin but accidentally creating the biggest supply shock in its history, hit that like button right now. Drop a comment. Did you know about the golden NSFR 85% rule? Did you know Basel III treats Bitcoin worse than any other asset class in history? Most people don't. And that's exactly why smart money is positioning now. Subscribe, because the next section reveals what the industry is saying privately. And it's damning. Let me show you what banks are telling regulators behind closed doors. These are public comment letters, but almost nobody reads them. I did. Global Financial Markets Association, GFMA, letter, August 2025. Representing major global banks, GFMA wrote to the Basel Committee with explicit warnings. Direct quotes. The crypto asset standards restrictive capital requirements effectively make it uneconomical for banks to meaningfully participate in the crypto asset market. These rules are constraining the ability of banks to intermediate and provide liquidity in digital asset markets. Translation. Banks are saying, we literally cannot do business in this space under these rules. White and Case Legal Analysis, published 2025. Major law firm analyzing Basel III implementation wrote, for banks wanting to provide Bitcoin lending, custody, or market-making services, the 1,250% risk weight creates a mathematical prohibition on economic participation. Mathematical. Prohibition. Not challenge. Not hurdle. Prohibition. Substack analysis. The invisible margin call, February 2026. Industry analyst breaking down the implications. The 1,250% Basel III risk weight that mathematically prohibits bank-level adoption creates a trapdoor under the institutional floor of $114 billion in ETF assets. The concern here is that if banks can't provide liquidity infrastructure, what happens when there's a mass redemption event in ETFs? Who's the bid? There's no bank market-making backstop because banks can't economically participate. Basel Committee's own admission, November 19th, 2025. The BCBS announced an expedited targeted review of the crypto asset standard due to market developments. This is regulatory speak for, we know this is controversial and might need adjustment. But the January 1st, 2026 implementation date remained firm. The rule is live while they debate changes. Jurisdictional divergence is creating chaos. United States, under the Trump administration, is signaling potential rejection or significant tailoring of the 1,250% rule. Crypto-friendly executive orders were issued January 2025. United Kingdom is also considering modifications, having delayed Basel 3.1 implementation to January 2027. European Union is following Basel III more strictly, implementing Group 2B treatment as written. Singapore is consulting on implementation, with the industry pushing back hard. This creates a global regulatory arbitrage. Banks operating internationally face the most punitive jurisdictions rules. Banks in strict jurisdictions are at a competitive disadvantage to US or UK banks if those jurisdictions relax the rules. The industry is essentially saying, this rule is so strict it's breaking the market, not protecting it. And while regulators debate, Bitcoin keeps draining into non-bank structures. If you're realizing that the biggest financial institutions in the world are screaming at regulators that this rule is unworkable, and regulators are ignoring them, you should be furious. But channel that into action. Hit that like button. Share this video. Comment below. Do you think Basel III's 1,250% rule will eventually be relaxed? Or is this permanent structural exclusion of banks from Bitcoin markets? Subscribe, because what I'm about to show you next is the endgame. What happens when the supply drain reaches critical mass? We've established Stage 1, Basel 3 1,250% rule takes effect, January 1st, 2026. Stage 2, Bitcoin drains into ETF custody, corporate treasuries, and self-custody. This is ongoing from 30 to 150 days. Now let me show you what comes next based on every historical supply shock in scarce asset markets. Stage 3, the compression, from 30 to 90 days from now. We're about 45 days into Stage 2 since the January 1st implementation. If historical patterns hold, we're approaching Stage 3. Characteristics of Stage 3, exchange balances hit multi-year lows. This is already happening, down to approximately 2,300,000 BTC. Volatility compresses. Price consolidates in a tight range as liquid supply dries up. Leverage builds on both sides, longs betting on breakout, shorts betting on breakdown. Institutional accumulation continues silently. ETF holdings remain stable or grow despite outflow headlines. Mainstream media declares Bitcoin boring. Attention fades and retail exits. This is the coiled spring phase. The market looks dead, but underneath, available supply is evaporating. Basel III ensures this continues because banks can't step in to provide liquidity. The 1,250% rule is a structural barrier. Stage 4, the violent breakout, from 30 to 120 days after Stage 3 begins. What triggers it? Historically, 3 catalysts. A single large institutional buy that exhausts available exchange inventory. Regulatory clarity that removes uncertainty, such as the United States or United Kingdom softening Basel rules. A macro catalyst that triggers flight to hard assets like a debt crisis, currency debasement, or geopolitical shock. When it breaks, here's what happens. Price moves violently in one direction, historically up 70 to 370% in 6 to 18 months. Short liquidations cascade. We've seen clusters at the $72,000 to $80,000 range based on data. FOMO hits late retail who sold during Stage 2. Banks realize they structurally missed the move and lobby harder for regulatory change. The pattern doesn't require belief. It's supply and demand mathematics. If demand remains constant or increases in supply available for trading shrinks. If whales and long-term holders don't sell, and 70% of supply hasn't moved in over 1 year, then price must rise to equilibrate the market. There's no other mathematical outcome. Historical precedent for confidence. 2015 post-McGox. Accumulation score above 0.65 led to a 100% rally within 8 months. 2018 post-ICO crash. Accumulation score above 0.65 led to a 230% rally within 6 months. 2022 post-FTX. Accumulation score above 0.65 led to a 370% rally within 16 months. Current data as of February 2026, accumulation score at 0.68. If it stays above 0.65 for 60 plus consecutive days, history says we're in Stage 2 building toward Stage 3. Here's what you need to understand right now. We are approximately 45 days into the Basel III implementation. Stage 2, silent accumulation, typically lasts 60 to 180 days total. That means we likely have 15 to 135 days left in this phase before compression begins. Comment below. Based on what you've learned in this video, are you positioned for what comes next? Or are you going to watch from the sidelines like 2015, 2018, 2022? Hit that like button if you want more content breaking down exactly how to track accumulation scores, exchange balances, and whale activity. And subscribe, because the final section gives you specific action steps, not financial advice, historical pattern recognition. Let me be crystal clear. I'm not a financial advisor. I'm giving you historical pattern recognition and regulatory analysis. What you do with it is your decision. But if history repeats, here's what every previous cycle teaches. Action 1, understand the timeline. We're approximately 45 days into Basel III implementation, which started January 1st, 2026. Stage 2 lasts 60 to 180 days total. Best estimate, 15 to 135 days remaining before Stage 3 compression. This gives you a window, not years, months. Action 2, monitor on-chain metrics yourself. Don't trust me, don't trust anyone, verify. Accumulation trend score, above 0.65, equals institutional accumulation confirmed. Exchange balances, declining equals supply leaving liquid markets. ETF holdings, net inflows equals institutional demand continues. Whale wallet activity, large wallets accumulating equals smart money positioning. If accumulation score stays above 0.65 for 60 plus days, every previous cycle saw 70 to 370% rallies. Action 3, avoid leverage. Remember the liquidation clusters I mentioned? Banks and whales use leverage against retail. Long liquidations at the $60,000 to $65,000 range. Short liquidations at the $72,000 to $82,000 range. They push price to trigger stops, absorb supply, then move it the other way. Spot holdings and self-custody. That's how institutions play this. Action 4. Think supply, not price. In stage 2 and 3, price is noise. What matters? Is Bitcoin leaving exchanges? Yes, at 2,300,000 BTC, a multi-year low. Are institutions accumulating? Yes, ETFs hold 1,050,000 BTC. Are banks prohibited from providing liquidity? Yes, the 1,250% rule. The supply shock is structural, not sentiment-driven. Price follows supply dynamics eventually. Action 5. Understand what Basel III actually did. This is the most important point. Basel III did not kill Bitcoin. It accidentally created the biggest supply drain in Bitcoin's history by making it untouchable for regulated banks. Banks can't lend against it. Banks can't use it as collateral. Banks can't provide market making at scale. So Bitcoin flows out of the traditional financial system into ETF custody vaults with 1,050,000 BTC locked. Corporate cold storage with over 650,000 BTC locked. Self-custody by long-term holders with 70% of supply illiquid. This is mathematically bullish for scarcity. It's just playing out on a 6 to 18-month timeline. Action 6, verify everything I just told you. I've given you the sources. Bias Basel Framework, STO 60, GFMA Industry, letter from August 2025, Skadden-Arps legal analysis on Basel crypto assets, CryptoQuant and Glassnode for on-chain data, Farside investors for ETF flows and BitBo for holdings. Read them yourself, form your own conclusions. The pattern doesn't need your belief, it just unfolds. Final question. Based on everything you've learned in this video, what's your plan? Comment below and tell me, are you going to track accumulation scores and exchange balances? Are you positioning in Bitcoin or staying on the sidelines? Do you believe Basel III will be relaxed, or is this permanent structural exclusion? I read every comment because I want to know if this research is actually helping people make better decisions. If it is, smash that like button one more time. Let's push this video to 10,000 likes so YouTube shows it to everyone who needs to see it. And if you haven't subscribed yet, seriously, what more can I show you? Subscribe right now. January 1st, 2026, the 1,250% risk weight rule went into effect. Banks now need $100 million in Tier 1 capital to hold $100 million in Bitcoin. Gold requires 0. Mortgages require $22 million. Bitcoin, 100%. The result isn't Bitcoin dying. It's Bitcoin draining out of tradable markets into permanent custody structures. 1,050,000 Bitcoin locked in ETFs. 650,000 plus Bitcoin in corporate treasuries. 70% of all Bitcoin hasn't moved on-chain in over 1 year. Banks are mathematically prohibited from providing liquidity. The GFMA told regulators directly, these rules make participation uneconomical. And while mainstream media talks about ETF outflows and price volatility, the accumulation score hit 0.68, the same level that preceded 100%, 230%, and 370% rallies in previous cycles. We're 45 days into stage 2. If the pattern holds, we have 15 to 135 days before stage 3 compression begins. Then stage 4 breaks violently. One last time, drop a comment. Tell me what city you're watching from. Tell me if this changed how you see Bitcoin. Tell me what you're doing differently after watching this video. Hit that like button if you got value from this deep dive. I spent 40 plus hours researching Basel, 3 documents, banking filings, and on-chain data so you don't have to. Subscribe, because the next video breaks down the exact on-chain indicators that signal when stage 2 ends and stage 3 begins. Specific thresholds, specific metrics, specific historical signals. You don't want to miss it. Because here's the truth they don't want widely known. The 1,250% rule was designed to protect banks. But it accidentally created the biggest supply shock in Bitcoin's history. Banks can't touch it. ETFs lock it up. Corporate treasuries hodl it. Long-term holders won't sell it. The data is public. The pattern is clear. The blockchain doesn't lie. The Basel documents don't lie. The only question is whether you'll recognize it and position accordingly, or whether you'll be asking 6 months from now how you missed all the signs when they were right there. Time-stamped, documented, undeniable. Thanks for watching. Remember, in Bitcoin, the real supply shock happens in silence. The only noise is regulatory complexity. But the smart money? They read the rules, they see the math, and they position before the crowd figures it out. See you in the next one.